Welcome to FounderLine, the show where we answer your questions about startups. I'm your host, Joe Beninato. Thanks for joining us today. It's great to have you all with us. Our goal with FounderLine is to provide a way for startup founders and employees to get their questions about startups answered by experienced entrepreneurs and investors. Maybe you're thinking about starting a company. Maybe you've already started a company and you have a question about a situation you're encountering. Maybe you're thinking about joining a startup and you want to ask some questions about how the company is performing. Whatever it might be, we're here to help you, and we're always looking for more questions from our audience. This is a live show. We're streaming it live over Ustream, and actually we're doing a bit of an experiment today. We've got Meerkat running on my phone right here to see how that might work as well. But the ways you can send us questions are you can email us. The email address is help@founderline.com, and you can also tweet your questions to our Twitter account. That Twitter handle is @FounderLine. With that, let's get started. Our guest today is David Wu, who's a general partner at Maveron, which is a consumer-focused venture capital firm based in Seattle and San Francisco. At Maveron, he's led investments in August Home and Darby Smart, as well as a third stealth company that he cannot mention. Before Maveron, David was a very active angel investor in almost 30 companies, including Postmates and Tile. David, welcome and thanks for joining us today.
Thanks for having me.
It's great to have you here. Usually, before we dive into the questions from the audience, I like to ask you a few questions, just so everybody gets to know you. The 5 people who are watching us get to know you a little bit. So you and I first met, I think it was like 97, 98 time frame. You were at Homestead, and I was a consultant helping out Homestead as well. And Homestead, went on for many years, finally acquired by Intuit. So I thought maybe you could start off talking about your time there and the process of growing Homestead into a big business, and then ultimately selling it off to Intuit, and what happened after that.
Oh, great. It's funny because I have a fond or not so fond memory of you and James Joaquin. You were both
That's right.
Consultants over at Homestead.
That's right.
When we first met, you guys were the marketing geniuses, and your inspiration was dressing me up in a Scottish kilt on stage at Internet Showcase.
Really?
Remember that?
No, that couldn't have been us.
It was
I
true.
think that was Justin who did that.
No, Justin got to wear normal clothes, and I was representing the Irish component on the other side of the share.
I don't remember that.
Yeah,
the thing I remember is that the company's name was Kartoffelsoft originally,
right.
And I kept telling Justin, dude, you have to change the name of this company. Like, no one's going to be able to spell it. Nobody's going to know what it is. And finally, they decided to do that. So that was our one contribution that I think we can take credit for, other than the kilt, which I had forgotten about. Yep. So thank you.
So when I started at Homestead, it was 18 people and a 28 modem, and we were doing a lot of consulting work, starting our own products. Justin, the CEO, was very inspired about kind of the educational space, and we started that first product based on his master's thesis about a programming language for kids.
Oh, that's right.
And then we figured out pretty early on that the people who needed help publishing and creating on the web were often the parents more so than the kids. And so we launched that first product, Homestead, that became a really early, disruptive, easy way to publish content on the web, in a way almost before its time. And it took off in the 90s and became a very popular way. We got 20, 30 million customers on board, 20,000 a day were signing up, and almost went public, almost died, and then we got to hang on by our fingernails and grow it up kind of a second time, and became one of the .com Web 1.0 survivors, and finally had that nice exit in 2007. But overnight success was a decade in the making.
Yeah. Well, and that's always the funny thing, is people remember sort of the last year or so, and
that's right.
And Twitter is a great example as well, right? Where they're clawing it out, multiple near-death experiences, and then finally pull it out. And that was, you guys kept at it for a long, long time. So how did you do that? That was you probably had some pretty dark moments in there. So was it just everyone said, we're just going to stick together and keep going until we figure this one out, or?
I think that we had a really strong culture back then from day one.
Yep.
And I think the the quality of the team and the people around the table, both in terms of the talent and in terms of kind of the passion about what we were trying to do. And also, even when we were going into that first web bubble, I think everyone we kept talking about how this isn't going to be sustained, that this isn't how the future is always going to be, and be prepared that this could change on a dime. So I think even when it started to go the hard way, people in the company part of them knew that might have happened, and we were in it for more reasons than just, the momentum of the bubble. And so I think it was tough, and we did all the hard stuff. We did layoffs, we did pay cuts, we did, just about everything we could on the way down. And I think you learn a lot more on the way down. But I think, we had a real culture around, cult-like culture around the company that held us through those tough times.
That's awesome. Well, and I mean, 10 years is a long time to do anything, right? I've never worked at a company for 10 years, so that is persistence, which I think is one of the most critical characteristics of entrepreneurs, is just being able to keep pounding away and someday you figure it out. So that's awesome. So then Intuit acquired you, and you stayed there a couple of years afterwards, right?
I stayed on for about 3 years, and ran several of their SaaS businesses. Someone's calling you on your Meerkat.
Meerkat's calling us.
That's when I loved being at Intuit for a while. I'd never worked at a big company, and it was sort of a brand new experience for me. I think over time I realized that definitely enjoyed the consumer side and the startup side more than what I was doing at Intuit.
Yeah.
And that's how I ended up being fortunate enough to get very involved in the angel investing side.
Got it. So then, 30 investments, almost 30 investments, I think I read, as an angel. Many of our viewers are entrepreneurs who have either raised a little bit of money or are looking for their first seed capital. And I'm sure they'd like to know, how did you find those 30 companies that you invested in? And then what were the factors that led you to decide, okay, I'm going to write these guys a check? I don't know what size checks you were writing in those days, but I'm guessing you were pretty early, frequently first money in, or in the first round probably. So maybe talk a little bit about your experience doing that.
So I would start off that, I don't think there's been a better time ever in the history for somebody to start to raise seed funding. I think there are more
than right now. Wow.
I think there are more pockets of early stage money than ever before in time. And even if you just look at kind of the micro VCs, I read a stat the other day that they raised over $4 billion of kind of new micro VCs just targeting early stage. I think you combine that with the Facebook and Twitter millionaires and the angel groups, there's just more options and more selection. And now the syndicates and angel list and all these crowdfunding platforms, there's literally money everywhere for early stage companies. So I think that, finding the right set of people to fund you for the right reasons that can be helpful and also are in it for the reasons that are the reasons that you're looking for is really key. Yep. But for me personally, I started off, I had decades of pent-up ADD over, as an entrepreneur, you spent all day long beating your head against the wall thinking about how do I make my company successful. And then once we had the exit to Intuit and I had some free time, the idea of taking some of those mistakes, I've made a mistake in just about everything you could possibly make in a functional area, and paying it forward and sharing some of that advice to passionate, less experienced entrepreneurs is where I started off. And the more I did it, the more I realized I really loved it. And I had one meeting with Mike Maples early on, and I said, I'm thinking about maybe doing this professionally. How do you think about that? Any advice? And he said that before he became a VC, he said, I decided I'm going to make 20 angel investments, and if one of those became a big hit, I was a VC, and if not, I'd go find a job again. And I took that advice very literally and started making investments and really took it very seriously. Some people angel invest based on they have 3 friends in different companies and they want to write checks for people they believe in. Some people write checks based on a thesis. I went out and approached it more or less full time, saying I really want to see as many companies as I can, get the pattern recognition I can around what could be a really big venture scale investment, and start to write checks that way.
Got it. And were those mostly consumer-oriented companies, or I guess you did Practice Fusion and some other SaaS companies?
Practice Fusion was actually the first angel investment I ever made. I actually took the first.
Pretty good first investment.
So far, it's still good. I took the first 6 months and said, I'm not going to make any investments. I'm just going to look at as many companies as I can. I got very involved in the Band of Angels, which is the oldest syndicated angel group, and I got very involved in AngelList, and they're sort of the polar extremes of styles of investing. And I went to as many due diligence sessions as I could, and I met as many companies as I could just to get that pattern recognition. And Practice Fusion is the first one that crossed that line that I said that, with everything I've seen so far, this is something I got to invest in. It had all the right ingredients, between the person, between the opportunity, between the timing, and it's so far so good. It looks like it could be an important company.
I think Mark Goines is in that company as well, right?
Yeah, Mark's in
so
that.
Mark says they're doing really well. All right, so now you're at Maveron, and Maveron, in my experience, is a little bit under the radar, at least here in the Bay Area. Started by Howard Schultz of Starbucks fame and Dan Levitan up in Seattle, and now has developed more of a presence here in the Bay Area. So I don't know what percentage you guys are doing, Seattle versus Bay Area, but it would be great to hear a little bit more about what you guys are doing at Maveron. Talk about the firm, maybe the type of companies you like to invest in.
Great. Yeah, so Maveron is a consumer-only venture firm. We're a highly specialized firm in that everything we do is about discovering the breakout consumer brands of tomorrow.
Okay.
As you mentioned, it was started in '98 by two coffee guys out of Seattle, Howard Schultz and Dan Levitan, that partnered with Howard when they took Starbucks public originally. Now Howard has since gone back to run Starbucks, and he's still involved in the firm, but doesn't make investments on a day-to-day basis or anything like that.
It's kind of busy, huh?
Kind of busy. We keep expanding our presence. Even from day one, it was a fairly national firm in terms of the investments we made. Our very first investment in '98 was eBay. But we've done everything from a board game like Cranium all the way to fast casual restaurants like Pinkberry and Potbelly that we just took public recently.
Yep.
And kind of noticed that the velocity and number of venture scale investments in the consumer side it's continued to get larger and larger year over year. And a big part of that is technology leverage. So one big difference from Maveron in the early days and now is that every investment we make now has at least some amount of technology leverage. And so we probably wouldn't do a fast casual restaurant. We wouldn't do a CPG that you're selling only through Whole Foods these days. But we like to take that institutional learning. And I think we have one of the best portfolios and one of the best alumni networks in and around the extended family that really understands how do you take a very early team with a great idea and help them build something that could be an enduring consumer brand. I think that we are very unapologetically team and founder driven. I think that what we've noticed is that in consumer deals, unlike some of the big enterprise or B2B deals that we don't touch, that really getting the DNA right of that left-right brain or that understanding of how to relate not only to the minds but the hearts of end consumers is so important. And so a lot of times we're betting on relationships. And so we specialize in sort of that Series A deal, but we'll generally go earlier than a lot of other firms before it becomes obvious. But we do that by knowing the teams inside and out and seeing how, not just how they pitch, but how they think.
Got it. So are you guys in the seed rounds as well, or do you usually wait for that to sort of develop a little bit, to get the product out, you see some early traction, then you do a bigger $5 million A? Like what's the sweet spot for you?
Our sweet spot for our money is sort of a $2 to $6 million Series A first institutional in.
Got it.
But in our ideal, if you look at our first 7 investments in our newest fund, our 5th fund, we've known the team a year and a half plus before we write that multi-million-dollar check.
Wow.
And we do that a lot of different ways, and one of the ways we do that is something you just mentioned. We have a very active seed program. We probably do 15 to 20 seeds a year, and we write kind of quite a small check for an institutional investor, usually $100,000, which is more of a handshake that says, let's really get to know each other a lot better. So by the time you're ready for that larger check, I don't have to explain to you what Maveron adds to the table. You had a chance to experience that, and I don't really need to see the Series A deck because I've had the chance to work alongside of you and learn how you really think.
Got it.
So we've seen that that's become a very effective way of getting to know these teams early on and see if they have the right stuff when it comes to consumer.
Oh, that's great. And something that comes up a lot is this worry about signaling risk. Like if you guys put the 50 or 100K in first and then you don't follow in the A round. So what's been your experience with that? I get that question a lot from people about worries about signaling risk.
So I have a couple schools of thought around this. On one hand, I've been an entrepreneur my whole life and only a VC for a little bit, so I try to answer.
So you're still somewhat good? Is that what you're saying? You're not completely evil yet?
Exactly. I try to answer, most of these kind of questions how I think an entrepreneur thinks about it.
Yeah.
I think there's always some amount of signaling risk. At the same time, I always generally give advice of take money from the best people you can around the table in terms of who's going to help you the most. So that's the starting point. We've also designed our seed program in a way that we're trying to do the best to mitigate signaling risk. So we really try to standardize the size of the check so that it's not, well, I like this one a lot. This one's a bigger seed check, and this one's a smaller seed check. So lately, we've really standardized on the size of that check.
100K.
100K. And we also don't follow on except for the deals that we lead or that has a big institutional round. And so we don't do seed primes or seed bridges because we think that creates a lot of signaling risk when, I think signaling risk comes from if you look at a venture firm's past pattern behavior and if they're picking special terms for some people and not others, then the question always is, well, why not you? We standardize the program. We tell everyone that it is a handshake to get to know someone a lot better. I think that's been able to mitigate a lot of the signaling risks, and especially because we like to add a lot of value along the way early on. But at the same time, we still see, startups that say, I just don't want any Series A investors. In fact, August Home is one of the examples that, we led the Series A, but at the Series Seed, we had known Jason Johnson for quite a while and offered really quickly to be part of the Series Seed. And because of Jason Johnson's pedigree and Eve Bahar as co-founder, they were way oversubscribed. And he said, I don't really want any Series A investors. So we just agreed that he would act as if we had invested, and we would stay that close, and we would meet on a regular basis. And I kind of kidded him that you owe me one at the Series A. And lo and behold, a year later, when he went out to raise his Series A, that relationship that we had over that last year and how well we got to know each other was one of the key reasons why Maveron and August Home are in business together.
Oh, that's great. Yeah, that's he gave you the honor of putting in money at a much higher valuation.
That's right. That's right.
That was so nice of him, wasn't it?
I know.
Well, I totally get it. I can imagine sitting there thinking to myself, all right, I want to work with these guys because I like them, good chemistry, but I'm a little nervous about any problems that might come as a result. So I've been through that as well, and we ended up my last company being in a similar situation, and it was just better to take the money from the seed guys and then talk to the Series A guys later.
We played around with the size of that check a lot, and what we found is that around 100K, we've really minimized almost all the signaling risk. And something that comes up a lot is we've had a lot of seed companies that say, we really like you guys, you're really on brand for what we're trying to do. Can you put more in? And it's just a very common request.
Yeah.
And pretty much unanimously now we'll say, because of the signaling risk, if we put more in and then we don't follow on or something happens, it's not worth it to you. You may not realize that now, but it will be.
You will.
Eventually. So instead, we'll introduce you to a bunch of other people. We'll bring our network into it. And there've been many times when somebody wanted to raise a little bit more from us. Instead, we introduced them to 5 people, and it got way oversubscribed past that. And we think that's a much better thing for the entrepreneur.
Absolutely. I totally agree. Well, that's great. I wasn't aware of your seed program, so that's good to know. All right, well, why don't we take some questions. Once again, this show only works if you guys reach out to us and email us with your questions. Our email address is help@founderline.com. And you can also reach us on Twitter. The Twitter handle is @FounderLine. So let's take our first question. I'll read it to you here. It's from Michael. It says, what are the things I should do to help you decide to fund me? What are some of the things I shouldn't do? What materials should I show up with? What materials are a turnoff? So questions about kind of the first interaction with somebody and the things that make you excited or not excited, sounds like.
Right. So it's very interesting, but now that I'm doing this professionally and spend a lot of my day meeting with entrepreneur after entrepreneur, we're always looking for ways to pre-screen or figure out how to use our time the most wisely. And probably the most unanimous answer you're going to get from professional investors is the referral is really important.
Okay.
And I think there's a school of thought that if somebody is not connected enough to find somebody that knows me and has to connect with me in the blind, that a job like a professional CEO is missing that networking ability. So the first thing I'm going to look at is who makes the introduction.
Okay.
And to be honest, there has not been very many deals as an angel or as a VC that has come in blind with no referral at all that we've wrote a check for. It's just, there's such a high correlation between who makes the introduction. So that's the first thing I would do is, make sure you have the networking skills to figure out who in the investor's network is going to, one, be close enough to that investor that they're going to give a very honest opinion of why you're a great person or a great company, and knows you well enough to give that endorsement. And I think that connection point is super, super important. And so that gets you off on the right foot and gets you in the door. I think,
would you even respond if it was a email over the transom? I mean, it probably depends what it is, but
I do occasionally, and to be honest, the main reason I respond to kind of cold emails is because as an entrepreneur, I want to embrace as much as I can of that pay it forward mentality. And I remember that blind email that I sent out that never got a response, and so I try to do that. But in honesty, a great referral jumps to the top of the list, and a blind email in, even with a great business plan, is with the extra time I have, I'll do the ones of those that seem to make sense to me.
Okay, but it's still hard, right?
It's still hard.
Okay.
It's still hard.
All right, and then so they get in the door, right? So what are the things that, it sounds like Michael was asking about the first meeting. Like what should he show up with, or what should he not show up with? I imagine a lot of these initial meetings are like coffee meetings, or at your office or at their office or whatever. So are you always expecting a deck? Should they have I get this question a lot about written business plans, which, I haven't seen one of those in a long time, but what sorts of things do you like to see or not see?
So I think it's different for different investors, but for me, the initial meeting, a couple things is that, again, as a professional investor now, we're seeing, person after person after person, company after company after company. I often describe that first pitch or that first meeting is not a comprehensive learn everything about my business. It's how do I cut through the clutter like a movie trailer that I want to follow up. Of the 10 companies that I see today, what's the one I'm going to be thinking about tonight before I go to bed? Or who's that one person? What is it about that? So I would focus on delivering less information, but something that cuts through the noise of why you're notable and why you're interesting. For me personally, because Maveron's whole thesis is we only do consumer deals and we're so about the entrepreneur, a lot of what I like to learn is what makes you special, and even better, what makes you and your team special. Even more so than, we'll get to the business model, we'll get to the product, but start off with you. And it was interesting, in my head I was thinking a lot, pitch me less on your company and pitch me more on why you're special. And what I believe is people that have had great successes in certain things are much more likely to have great successes in other things. And the more related your past success has been to what you're doing now, even better. But we'll see people that were tremendous athletes, were tremendously successful in nonprofits, were amazing people in industry that are unrelated, and that past interesting texture of a person and the people they've assembled around the table is more than enough to get that second meeting. Your goal of that first meeting is to get that second meeting. You want to be prepared, you want to be thoughtful, but the person that comes in and spends 30 minutes and it's not an interaction and just starts pitching their story end to end is much less interesting than having a conversation with a person about why this is interesting, why you're interested.
And connecting, right?
And connecting.
Because I know in my experience, I like to have conversations with people, and it's very possible. Like let's say I was working on a sports related company, and you just don't care about sports at all. It's very unlikely that you're going to fund it, right? No matter what, like we could show you projections, and you could even believe that, oh my God, that's going to be $1 billion next week. That might get your attention a little bit, but if you're not passionate about the area that that person's working on, odds are very low that they're going to spend more time on it, right? So I always tell people it's a combination of like, telling your story and the VC or the angel kind of falling in love with the team and the area that you're focused on. Otherwise, it's not really a match. And you shouldn't take it personally. Like there are plenty of good friends of mine who turned me down for an investment because it just wasn't the right fit. But I know that someday, we're gonna work together on something else, right? And so hopefully, Michael, that helps answer it a little bit. Any things that are a turnoff for you? Like if they show up with a binder full of spreadsheets, like I'd imagine that might be a little weird, right?
I think that the turnoffs are, one, people that aren't respectful, and I think that's true both ways. Oftentimes you see VCs that are not respectful of an entrepreneur's time either.
Playing on their BlackBerry.
Not showing up on time, or coming completely not prepared and
Okay.
such. That's the starting one. That's a turnoff. I think that I love entrepreneurs that are very confident in their abilities and what they can do, but there's also a line of when that confidence goes to being, arrogant and not knowing what they don't know and not listening, or like you said, I think it's very important to make that connection. So another no-no is to kind of not know your audience and spend the whole time just going into pitch mode.
All right.
Because I think that we're trying to have a conversation and get to know each other. I personally prefer not the deck, not a structured pitch. I want to learn how somebody thinks.
Yeah.
And I can only learn how somebody thinks by having a conversation. A Hollywood actor can recite a deck that may not even been written by them. And so the less structured and the more conversational is, the better, I would think.
I agree. I definitely agree. Yeah, it's tough because I would show up at meetings without a deck, and then people like, aren't you going to plug in? Like you were at their office or whatever, and like, no, and that like freaks some people out. But if that causes problems, then I'm kind of like, then it's probably not a good fit anyway. So no, those are great suggestions, Michael. I hope that helps out. Let's move on to another one here. This is from Sandy. It says, what unicorns did you miss out on? Why did you miss them? What are the investments you regret passing on? So a little probing there, but any that you can remember, your Twitter or Facebook or Instagram story that.
I'm still relatively young to this side of the table. I every day when an Uber goes by and I see an Uber, I wish I had made that investment, but I have the excuse that I wasn't an investor, I was an entrepreneur at the time that Uber started.
Was that a company you could have invested in? Like
I think timing-wise, it wasn't yet.
Yeah.
I mean, and so I don't think, we do keep track at our firm. We spend a lot of time talking about things that we looked at that, we kick ourselves that maybe we should have done. Stitch Fix is an interesting one. It's still fairly early on, and we looked at it very closely, and we didn't understand the use case well enough in the size of that opportunity. Warby Parker's another one that our firm had looked at early on, and we didn't think that the team had the operational experience to build a really big company. But in hindsight, I think we underestimated how amazing they really were at creating a brand. And so we talk a lot about things that we looked at that we coulda, shoulda, woulda, but on my personal side, I'm still early enough that I'm keeping score, but there hasn't been a missed unicorn yet.
All right, well, we'll keep hunting for those missing unicorns. All right, here's another one from Thomas. It says, I've heard people say that they went with a VC that was a better match, but not the VC with the best term sheet. What do they mean by this?
This is a great question. I think people underestimate how important finding the right match for you on a VC can be. And especially as you get past the seed stage into the Series A and the Series B stage, it's more akin to a marriage, but a marriage that's very hard even harder than a divorce to break up. And it's a combination of advice, control, and money. And when you lump all those three things together, it's amazing how important it is to get the right alignment of what success looks like. And VCs are not doing it altruistically. VCs do it professionally, and they raise money from other people that they are also on the hook to deliver certain results in certain time frames. And as an angel and as an entrepreneur, what I didn't realize is how important it is to get the alignment around that table, that everyone's trying to make the same long-term, short-term trade-offs and do the same thing. All the way to, I've seen companies about ready to go public when the people around the table had different ideas of what they wanted to be doing, including whether to go public and at what price and those kinds of things. So I think that nothing matters in terms of the economics until the end. Unrealized gains are, as an angel, I love my unrealized gains. We were talking about this earlier, but realized gains is what's really important. You see lots of these companies have intermediary price points that don't mean much. It's sort of like I was up $1 million last night at the casino, but I still left with zero. Those midpoints matter less than getting the right people around the table that are going to make a successful company. And as you keep going on, you're going to be making a lot of big decisions. And you want to make it with people that share the same values and have the same idea of what success looks like. And you can, right, especially in this environment, you can find a wide range of structures and price points on an intermediary milestone. But getting people that you would hire if you were going to hire them onto your team, because it's sort of like hiring a senior person on your team, on your venture partner, and you're bringing on board. And if you use that same criteria, which is, would I hire this guy if I could?
Right.
It's like hiring somebody that's giving you money, which is not only you hiring them, but you're obligated to them to some extent because you're taking their money.
All right. Well, good. Well, we're about halfway through the show, and we're going to take a minute now to thank our sponsors. So relax, enjoy a cold beverage, and I'll take care of this for a minute. Well, let me first say hello to our friends on Meerkat. We now have 3 people on there. Let me see if I recognize any of these guys. Hold on, there's something on there. I can't tell who they are. Oh, Aaron. Aaron's on there. Aaron and I used to work together. And John Canfield and a Bulldog. Oh, Bulldog stickers. So we got 3 people. Big crowd out there on Meerkat. It's a total experiment. We weren't sure it would actually work, but there you have it. So let's go to the sponsors. We couldn't do this show without the amazing support we receive from our sponsors, and that includes Oric and Square One Bank, Accretive Solutions, and Ustream. And I'd like to just walk through and talk a little bit about each of them, just so you guys know why we are working with them and give you a sense. So first, I want to thank Mitch Zuckley and his team over at Oric. Mitch and I have been working together for a long time on multiple companies, and Mitch is one of the founding sponsors of FounderLine. He's really one of the main reasons why we're here on the air today. And when you're thinking about a startup, you really want to have great legal advice. And yes, they're going to do your contracts and your employment agreements and all that sort of stuff, but mainly you want a good advisor who has seen hundreds of transactions and been through almost every situation that you're going to encounter on your path through your company. So a lawyer is usually one of your closest advisors. Many of them will work with you to be founder friendly on the terms and everything. So I've worked with those guys a long time. I think they're the best. If you want to find out more, go to oric.com and you can see more about Oric. Next, I'd like to thank our new sponsor, Square One Bank. So they came on board for this new season of FounderLine, and I've been working with Lori Lumenti-Gardi there, as well as Sam Baumick, for a number of years through multiple companies and banks, as it were. But when you're working on a startup, it's also really important to have a great financial partner who can not only take care of the basics, like making sure that your money's safe, but help you out as situations on your financial needs arise, help you in whatever comes along, and mainly just make it really easy for you with online banking. And one of the biggest mistakes I see founders do is they put everything on their personal credit card, and then company blows up and they're left with a bunch of issues there on the financial side. So they can set you up with a company card that is tied into your company finances as well. So the team over there at Square One is great. If you want to find out more, you can reach out to Lori Lumenti-Gardi, and you can find her on their website. It's their URL is squareonebank.com. It's square1bank.com. We also have another new sponsor this season, Accretive Solutions. They are the leading business outsourcing firm in Silicon Valley, and I wasn't sure exactly what business outsourcing was, but it's basically your CFO, your financials. When you're busy building a company, the last thing you want to be doing, and I've been through this, so I know this, is like making sure that people's paychecks are correct and that you're paying the right amount to the people who are billing you for things. And so getting a partner involved, even in the early days when maybe you can't afford full-time controller or CFO, you can go to someone like Accretive. And I've worked with Martini there for a long time. She was my interim CFO at Tello and at a previous company. And so, you want somebody who you can hand this stuff off to and it's going to get done correctly. And that's a huge issue for an early stage startup. So If you're thinking about getting someone to help you out with that, call Martini and she'll be able to help you out. Their website is as-bos.com. So it's accretive solutions business outsourcing services.com, as-bos.com. And then finally, I'd like to thank another of our founding sponsors, Ustream. Brad Hunstable and the team have been with us since day one, bringing you the content you're seeing here live. And their streaming technology is the best. If you're thinking about streaming meetings or you have employees in multiple locations, whatever it might be, Ustream is a great platform for taking care of those. And you can find out more at their website. It is ustream.tv. So, wow, I'm out of breath after all that. We went from 2 sponsors to 4 sponsors this season, so we got a lot more commercial time in there. But we've got about 24 minutes left, so let's dive back into the questions. And again, if you want to reach us, email us at help@founderline.com, tweet to @founderline, and we're going to go back to the questions. And okay, so this was one we got yesterday, and it's kind of a mega question. So I'm gonna read through it so you can
help me through this.
Yeah, I'll help you through it. It's from Larry, who is one of our regular viewers, and he's working on a company. So Larry says, I've been funding my startup's expenses for a year with no salary. Some exec team members believe that my not drawing a salary may be keeping their salary lower than it would otherwise be. We are raising our first friends and family money, and I sense some personnel may feel that higher salaries are warranted because of the new money. I want to retain my team and minimize discontent while continuing to be financially prudent. All makes sense, Larry. So here are his questions. And I'll read all of them, and then when you forget all of them, we'll come back. So when should a CEO draw a salary? Does CEO salary set a presumptive ceiling on the other salaries and create discontent if it is well below market? How do new investors react to a CEO not drawing salary when self-funding, but then drawing a salary when the new money arrives? And then how do you respond to the expectation that new money can bring higher salaries? So let's start off with when should a CEO draw a salary, or you can pull pieces out of this. That's kind of a big issue, and I remember going through that myself, like thinking, gosh, do I pay myself yet? Oh, if I pay myself this much, is like some VC going to be pissed off at me? Should I be lower than my employees? Should I be higher? How do you think about that whole ball of wax?
I think this is a great set of questions. And
we could spend a whole show just on this, right?
It is quite complicated. I do think that the founder's compensation is oftentimes different than the rest of the firm.
Okay.
And it's because fundamentally their equity position is so different than
so
the rest of the company.
Is that what you were going to say?
It's really different. So I think for starters, I don't think necessarily the CEO or the founder's compensation package just being too low or too high necessarily has to telegraph what happens to the rest of the firm.
Because they own so much more.
Because they own so much. So I've seen many cases when a company wants to start hiring C-level executives and needs to pay a certain amount to get that caliber person, and yet the CEO or some of the people around the table are still either deferring salary or taking a fraction of their normal salary.
Like a real fraction, like 25% or 50%.
Or even minimum wage. I mean, I think in theory you're not supposed to pay employees zero because of some of the things like laws and HR. But I would say you're trying to triangulate between, especially paying a lot of salary early on can be quite dilutive because it shortens your runway enough that you're not getting to a great next milestone.
Right.
And I also think that investors, when they're coming in, are going to look for people that are very prudent with their money. And you're trying to balance that with, as important or equally or more important is, how do I get the best people around the table and the best possible team? And consistently, time and time again, probably the best indication of a company and a team that's going to be successful is that entrepreneur that again and again is hiring people that you scratch your head and say, I don't know how you got that person on your team when you're where you're at, especially for that salary. And so you triangulate that all together. So I would say that, on this compensation thing, you're always balancing those two. I think definitely a CEO that pays himself a lot of money or herself a lot of money and his executive staff a lot of money that's way out of whack with how much money they've raised so far is a huge negative signal to the VCs, because VCs want somebody that is going to be as watchful with their money as they are with their own money.
Well, let's put some numbers to it. So let's say they raised $1 million, and it's a team of 3 or 4. So what would be a warning sign to you, like if all those people were making 100K, 150K? Like what would be a signal to you that something weird's going on?
I mean, I think that without exact numbers, if somebody raises $1 million and is spending, hundreds of thousands of dollars a month on salary, that's not a lot of runway.
Yeah,
and then if you look, and where's that salary going? If somebody came out of a big warning is somebody that came out of a big company and had a, big company fat salary in the hundreds of thousands of dollars and decides, I don't want to take a pay cut. I'm not going to make any sacrifice to start this company, and pays it to themselves, and yet only raised $1 million of funding. I've seen VCs saying, in an extreme case, you have the nerve to come and ask me for money when you're paying yourself that grand salary and you only have 4 months of runway in the bank.
Right.
I mean, that doesn't make sense. It's a lot of, of conflict in that. I think on the flip side, VCs love people that, spend no money and somehow have this dream team that is fired up because of equity, because of the vision, because of the opportunity to build a great company. I do think, I've had an example of one of the issues sometimes with founders, especially serial entrepreneurs, I think you would understand this pretty well, where the lifestyle and economic situation of the founders are not balanced. Maybe it's a serial CEO that actually has a lot of money, and a couple co-founders that maybe don't have their first one and they need that paycheck. And how do you balance that out? I actually have met a few CEOs that decided I could fund this myself, but I'm going to raise money for that exact reason, because that'll allow me to pay the salary, even though I don't need it, but to pay the salary to the rest of the team around the table and adjust the equity appropriately. A lot of times people will balance that equity ownership and the salary, or the deferred salary in a way, to balance that out. But it is an issue sometimes when you have a very successful, rich, founder paired up with, some people that, need to make the bills.
Yep, I've definitely been through that, and so it's always a trade-off. I always tried to get people, kind of like 2/3 of the way to market, so they're feeling the pain a little bit, but maybe give them a little bit of extra equity just to make up for that, and then as time goes on, as you raise more and more money, you're able to get them closer and closer to market. The thing I hate, though, this is one of my pet peeves, is like the people, and no offense to your Intuit friends, but like come out of a big company, and they're like, well, I can't do this for less than $250. And it's like, well, then you shouldn't work in a startup. You should go call Yahoo or Google or one of the other big guys, because a startup with seed funding of $1 million paying some exec $250K right out of the chute, it's as a recipe for disaster. So I don't believe in like paying people ramen, like 40K sort of salaries, because I think that also creates, like, they're spending more time worrying about providing for their family than they are about building your product, right? And so there's kind of this dance that goes on, and across the different employees. Some who have had exits, some have not, right? I mean, it's usually a mix of all those people. So I don't think there's a one simple answer in there.
I was mentioning earlier that there's never been a better time to raise money, and it's probably easier than ever if you have a decent story to raise seed capital. I think the flip side of that is that there are more safety nets, and there's less sacrifice to be an entrepreneur. You talk about the old days, people had to crawl across broken glass and give up a lot of sacrifice to start a company, probably defer a lot of salary and really scrape by. There's less of that now. There's enough incubators, accelerators, angel money that you might be able to get that big salary and start a company and do all these things. And as an investor, we spend a lot of time trying to also screen for that grit, which is, if you didn't give a lot of sacrifices, how do we know when times get tough, you're not going to bolt or get bored? And so we look for that a lot. And I think that that's kind of a new dynamic that's coming up in this Intuit thing that you mentioned, which is you kind of want a team that is, through thick and thin, not coming just because they can have their cake and eat it too, because they can have a great compensation package with no downside and take a swing for the
And all
fences.
upside, right.
So finding that balance is really important.
I always look at the offices. So I just funded this company, Calypso, recently.
Oh, yeah,
I don't know
yeah.
if you met those guys. But like they're in this garage, like in an industrial park in San Carlos, I think it is. And I walked in there and I was like, oh, this is awesome. Like these guys are watching their pennies. You know, they packed as many people, and it actually reminded me a little bit of the early Homestead.
Oh,
I don't know
yeah.
if you remember that building, it was like an industrial park off of Edison Way, and you know the rent was really low, but they made it a cool environment. And you know, when I walk in and it's like the glitzy, you know, not quite Sand Hill Road address, but you know, fancy offices, and everyone's got Aeron chairs and Herman Miller, you know, furniture. You know,
Right.
you're kind of like. And you've raised how much so far? You know, like that's a scary sign for me. I know that's very esoteric, but it's just sort of a signal of what might be, you know, coming down the road, right?
I think Jeff Bezos still has that frugality embedded in one of their core values. And even now, at the size that Amazon is, I think as a rite of passage, on people's first day, they build their door desk.
Oh, really?
They're going to use, and that's embedded in
Awesome.
the culture. So
Yeah.
I think that, you know, that holds true even for large public companies, that when people, I think a friend of mine who's a CFO said that if you can run a correlation between people moving their public companies to a Taj Mahal new office and missing their quarter numbers, and he said it's uncanny.
Yeah. It's 1-to-1 pretty much.
The other thing I was going to add real quick is that in the early days at the seed level, having different compensation packages for different people that look sort of uneven or unfair is commonplace. You're going to have to go through this because every individual has different needs in terms of their, you know, economic situation, where they are in stage of life, and what they're leaving to do that.
Yeah.
I think that the goal that we always tried to use in my companies in the past is that if you imagined that everyone had full access and information to everyone else's full comp, including equity, including deferred comp, including salary, that you could explain why you made the decisions that you made,
Yep.
and that you correct anything that's different over time. You can't correct them all at the same time, because you're going to have to make an exception that this super rock star that you really want to hire, you know, needs a certain salary, and you can't raise everyone else's salary to match that, because then you run out of money. So how do you juggle that? You come up with a kind of set of guidelines of what you think is fair, and that you can explain why you did what you did.
Yep.
And over time, you fix that. You fix it with equity. You fix it by correcting. But
Well,
you can't do it every single time. Otherwise, you just raise all boats and you run out of money.
And it is true. Like occasionally, you do find something like that on the printer, right? And so you do have to assume that will happen, or that people will talk and be like, well, I got 1%. What did you get?
Right.
And you know, those are awkward situations. So Larry, I don't know if we got everything in here. Oh, so what about this thing, the expectation? So the friends and family comes in, and like there's an expectation around, okay, now we all get raises. So what would you say in those situations?
You know, I think it's a reality that when a company brings in more money, that the expectations is if somebody has been taking a really big haircut, that you're going to try to meet in the middle somewhere. And I don't think there's anything you can do to avoid that set of expectations. I think the more transparent upfront you are about what the kind of psychological contract in terms of compensation is, and having some kind of transparent compensation policy of how you think about it, so that when we talked about earlier about these one-off situations, that you have a more holistic way of how you're thinking about it. I think that breeding into the culture that you're trying to build, it's not a sprint, it's a marathon, and you're trying to build a really long, enduring company, and dollars you're bringing in isn't to reward people at the starting gate, it's to build that enduring company, and every dollar we're paying out
Yep.
could be going back in the company, and being fair about that will help balance of, you know, even later stage when you raise that big, you know, round, everyone's, you know, not popping champagne bottles, they're going to go back to work and focus. You know, we have a few public companies, you know, Trupanion the other day went public, and Daryl talks a lot about, you know, I've spent a lot of time on the culture, having people not focus on the stock price, because we have 20 more years of work to do before we even get close to some of the achievements
great.
we want, and focusing on what success looks like as a team, as opposed to, you know, just how much money did I make today.
Yeah, no, that's great. You know, one of the things that comes up with employees, especially those who have worked at larger companies, is they say, well, my salary was this and my bonus was this. And I just head that off at the pass right there. I say, there are no bonuses in this company until we get to profitability. So get us there, make your stock more valuable, and then we can talk about bonuses.
Right.
Just so there's none of this, like, oh, I was expecting 20K for my bonus, and it's like, are you serious? Like, we're really talking about that? Like, we're losing, 800K a month. Why are we even having this conversation? So Larry, I know a little bit about Larry's company. I don't know if that helps, but my suggestion to you is if you have people who are really this focused on salaries and if he's taking less money, is he artificially driving things down? You might consider whether or not those are the right people for your company. I don't know those people specifically, but I think you always have to be evaluating, is this person cut out for this? And sometimes they're experts in whatever field. This is in the medical field, so it could be there's a certain expectation coming from doctors and medical professionals as opposed to Java programmers. But anyway, hopefully, Larry, we got through some of that, and if not, let us know, and we'll try again next time. Let's see if we can get a few more going here. So this one's from John. How do convertible notes work, and what are the advantages of them for me? So I don't know if you mentioned your seed program. Are those typically convertible notes, or do they have to be equity, or
Our seed program, as I mentioned earlier, is really about more of a handshake or a token gesture that says that let's spend more time together. So we tend to be very entrepreneur friendly, and regardless of the structure, we're pretty open to doing that check if it makes sense for us to spend that more time together and participate. So as a result, we end up seeing a lot of convertible notes. That's probably one of the most common structures these days. I think the convertible note has become really popular because it's very simple and it's reasonably consistent on the terms from convertible note to convertible note. And a convertible note is basically a debt instrument, which is I'm going to lend you this money and you're going to pay it back to me with some interest. And I think that was, it used to be that was done for short amounts of time or bridging between rounds. But because it's such a simple structure that anybody, even without a lawyer, understands, the convertible note has become sort of, especially the Silicon Valley de facto way of doing a lot of these seed rounds. A lot of people have done a lot of seeds, especially syndicates. Don't really like it that much because it's not exactly the right structure, but it's become very, very common. And then what has happened over time is people said, well, interest plus the investment doesn't really reward the upside. If I lend you some money and you turn this nothing company into a $100 million company and I get my interest back, that's not much upside. So then they started adding a discount, which is basically saying, we have no idea how to price this round. Maybe it'll happen next time, in the next round. Let's just assume that we don't have the skills yet to figure out what this is worth. But for sure, I want a discount to the next round. So when the next round happens and it gets priced, I get 10% better than that. And so that there'll be a convertible note with a 10% discount. Even then, people were starting to say, especially the sophisticated investors, that's not enough of a kiss for me being in there for you as the first money in the tough times. And so what has happened now, and it is the most common note, is the discounted convertible note with a cap, which means at most, even when it's priced next time, that a $10 million cap or a $7 million cap says that at most, even if I create enough value, this is a $1 billion company, I'm going to get my equity as if this was a $7 million company or a $10 million company. Right. So that's the most common structure right now, and I think that there's pros and cons to it, but it's the simplest.
And just on the cap, most people know this, but cap on the pre-money valuation, right?
That's right.
So the idea is, the money comes in and you use that money to make the company more valuable, and in some cases, on $1 million, you could turn it into, let's say, a $30 million valued company. And the seed investor's going, man, I just got screwed on that. Like, if we had priced that, it would have been a $5 million deal. So that's where the cap came from. And hopefully, I forget the name, whoever asked that, I lost the email here. But hopefully that helps you understand how that works as well. So,
and there's a lot of great resources online that can actually walk through the most common terms of those notes.
Exactly. It was John who asked that question.
Thanks, John.
Okay, Ben. How do you decide when to pivot? Do most companies pivot too early or too late? Well, that second part is really easy, I'm pretty sure. But so what do you think? How do you know when to pivot and when and is it too early or too late? I guess if you're out of business, it's too late.
I think that if you're out of business, it's too late, or if you're about to run out of money. I mean, that's the number one rule of entrepreneurship is don't run out of money. So I think that's a guiding factor.
Yep.
I think that when do you know how to pivot? We spend a lot of time, as I mentioned, because we do consumer. So a lot of my answers are specifically around consumer, is we try to first identify a team that has the right DNA and is passionate about what they're trying to do.
Yep.
Then we look for teams that iterate really quickly. And one of the key things on the consumer side is somebody that, instead of in an ivory tower building what they think is the next great thing, gets some kind of MVP and gets it out to the end customers and really starts to learn what the customers like. So I think it's never too early to pivot, and there's gradations of pivot as you're learning from the end customers more about what they like and what they don't like and what they want. And what we find is consumers actually act very irrationally, and you don't know until you know. And what we like to look for is deep engagement, where somebody sees a product or a service that is connecting enough with their day-to-day lives that they almost can't imagine life again without that. And that's what you're in search of. So I think a lot of the early days, it's hunting and trying ideas and iterating really quickly. So it's almost not a pivot. I think a pivot is more once you start to say, this is my business, and you march pretty far down there and then realize it doesn't work and have to make a quick snap direction back in another direction.
Yep. So hope that that helps out, Ben. I think, having been through a pretty massive pivot at my last company, Tello, you kind of know in your gut, like you can tell, we've tried like 30 different things and this is not working. And I can only tell you from my recent experience, we knew right away that we were on to something with the new thing, and literally we launched it and 4 days later had an acquisition offer waiting for us. And so that's how you know you're doing something that's right. Either the consumers are using it or the users are paying you, or like something's taking off. If you can, there's something about persistence, right? Which I think is a critical aspect of any entrepreneurial journey. You have to keep trying, but at some point, even the most persistent entrepreneur needs to say, we got to try something else. And but I totally agree with your point. Like, all startups are constantly pivoting. Like if you're not, and pivot is kind of the newfangled word that got thrown on it. I mean, it was always experimenting and adjusting and trying this. Oh, that doesn't work. Trying this. And so I think that's just part of the DNA of a good entrepreneur. And the massive pivot is sort of what's become more, not in vogue, but more common as the switch businesses, because this one's not working.
One of the things that I noticed is that, like at Homestead, the 10-year journey, for example, that your long-term kind of mission and vision of the company and that guiding light of the company, even through all of our changes, stayed relatively constant. And even tying that back into, this is the kind of company we want to build, and this is why we hired the kinds of people around the table with shared values and certain skill sets. That always was a kind of our guiding light. Then when you pull in the horizon to 2 years out, 1 year out, or 6 months out, it was a freaking mess. Like every day we're changing and iterating and throwing stuff against the wall. I think that the pivot that is more dramatic is we were a B2C company and we were told maybe we need some enterprise customers, let's go in a completely different direction. I think making sure that, one, you look back at, are those things that when we define success, is that still something we're passionate about? And is that still something that this is the right unique team to tackle that or not? Sometimes some people lose sight of that. Yep. And so, I think that short-term iterating and going like crazy is in the DNA of the entrepreneur. But that long-term play, you're always going to get a lot of advice to tear down your business and build essentially a different business. And the questions you have to ask yourself is, am I losing what I started off, the reason for my being, and the guardrails of why I build this business?
Absolutely. Well, unfortunately, we're out of time, so I know this flies by. David, thanks so much for being with us today. You can look up David at Maveron's website, maveron.com, or find him on Twitter. His Twitter handle is @DavidW. That's 2 Davids and a W. Tune in next week for another episode of FounderLine. Our guest will be Dave McClure, who is the founding partner of 500 Startups. And if you know Dave, there might be a few F-bombs, and it's going to be a great show. So that'll be next Wednesday at our usual time, 5 o'clock Pacific time. Thank you once again to our amazing sponsors. We can't do this without you. That is Oric on the legal side, Square One Bank, Accretive Solutions, and Ustream. Don't forget to follow us on Twitter. Our handle's @FounderLine. You can send us questions during the week if you want to for Dave, and we'll get them ready for you. You can email those to help@founderline.com or tweet them to us, as I said. You can check out our website where you can subscribe to email updates and watch our previous episodes, as well as subscribe to our podcast on iTunes. Thanks for watching. Here's to the crazy ones, and we'll see you again next week.